Edge designations, CFA Level 1, pre-reading, financial statement analysis, learning module 6, long-lived assets. This is really the first learning module related to long-lived assets. In other words, the one that we're going to be doing now in the pre-reading. Always important to remember that there is another long-lived assets learning module, and that then will come a little bit later on. That then belongs to the core readings that come a little bit later on. As we see over here, as per normal, okay, we have all of the learning outcome statements for you for learning module 6 related then to long-lived assets. Let's get ourselves going straight away. First and foremost, just important to remember, it does have a bit of a fancy name, long-lived assets, this learning module 6, but it's just non-current assets, longer-term assets, and that's essentially what we'll be dealing with in this particular pre-reading. Okay, first and foremost, remembering that one of the key long-lived assets that we'll work with is called property, plant, and equipment. And when we purchase property, plant, and equipment, okay, what happens is that it has a certain value, that's its cost, that's the amount that we paid for it, but over time that value erodes, or the correct word is depreciates. Okay, so over time, and however long we believe that asset will last for, we write that asset down, or we depreciate that asset to the extent that by the time it's reached its end of its useful life, the value then will obviously be zero. Okay, and we just send you back to the previous study session, which was that relating to income statements. We already spoke a little bit about depreciation and depreciation methods. Okay, so first and foremost, just to remember that, and we spoke about this earlier as well, okay, in terms of property, plant, and equipment, in terms of most long-lived assets, okay, IFRS, okay, allows you to record your asset using the cost model. What's the cost model? The cost model is that I bring the asset onto my books at what it cost me, and I depreciate it over time, the useful expected life of the asset. The revaluation model is a model that we use, and to the extent that the value of the property, plant, and equipment goes up over time for whatever reason, obviously more related to things like real estate or things like that, and the value of the property, the value of the non-current asset has increased, we will then show the asset at its increased value or its fair value. Very important to remember, and this is one of the key differences then between IFRS and US GAAP. This method is not allowed per US GAAP. US GAAP, if we are looking at its methodology, US GAAP will only allow the cost method. Okay. When we look now to depreciate my asset, okay, we look at 4 different factors. The cost of the asset, what did it cost? Its residual value, in other words, at the end of its life, will there be any value left over? That's called the residual value. The depreciable cost. The depreciable cost is the amount that I then need to depreciate it by, which is cost less residual value. And then, of course, we've got what we call the estimated useful life, how long we believe the asset will be around for. The different methods that we've got for computing depreciation, okay, we work on the straight line method, the production method, and it's called declining balance or diminishing balance method. Those are the different methods that we could perhaps use. Let's have a look at each of these particular methods. Okay, we'll do this by way of example. The vehicle was purchased 1 Jan 2011 for $1,000. The vehicle's estimated residual value at the end of its life of 5 years is $200. Okay. So there's all the numbers. So first and foremost, okay, we've got to work out how much are we going to depreciate this asset by. What is the total amount? So first and foremost, that'll be my numerator, and that's called the cost price, which is $1,000, which we've taken from there, less its value at the end of its life, so minus 200. So its depreciable value then is $800. How long do I anticipate having this vehicle for? A period of 5 years. Divide that then by 5, okay, and I will depreciate the asset by $160 per year, and In other words, and then I will do that for 5 years. At the end of its useful life, okay, the asset then will have been depreciated then by 161 across the 5-year period, and it'll have a value at the end of its 5 years equal to $200, which will be its residual value. Okay, what happens if I now change the expected useful life of the asset and say I think this asset can go for 10 years? Well, same story for my numerator. It's the cost less the residual value. The estimated useful life then is 10 years. Now, being the depreciable amount is still $800, which is cost less residual value. But now I believe I'll have it for 10 years. It is $80 then per year. Okay. Next method is called the production method. What does the production method do? The production method says we're not working on how long, or it's not a time based necessarily that I'm going to be working on, says this particular method. Okay, what it does is it works out on the amount that we actually use the asset for. Let's have a look over here. Okay, the production method says my numerator remains the same, cost less residual value, but now I say, well, oh, look over here, my vehicle has got an estimated usage of 400 miles. So what do, guys? Then I say, okay, well, hold on a second, I'm going to go take my $600, sorry, my apologies, I'm going to take my $800, which is my $1,000 cost price, less residual value. There's my $800, the depreciable amount. I divide that by 400, but now it's not a life, it's 400 miles. What does that tell me? Okay, that every time this particular vehicle drives a mile or is used for a mile, okay, I should depreciate it or write it off by $2 per mile. In other words, if the vehicle travels 50 miles in its first year, okay, the depreciation expense will be $100. Everybody comfortable? We've got an interesting method over here called, which is quite an accelerated depreciation method. It's called the declining balance method. And what is this declining balance method? Okay, that there are going to be it's a depreciation method that advances depreciation in the early years of the life of the asset, creates large amounts of depreciation in the early years and later on in the later years. Okay, and let's have a look at an example of this. Okay, and what do we notice? Okay, that in my very first year, the date of purchase, there's $1,000. End of my first year, what would I depreciate it by? Okay, we have a look over here. Okay, $1,000, okay, times by 40%. It's an accelerated approach. Okay, everyone comfortable? So my depreciation in the first year is $1,000. What do you notice first and foremost when we deal with this particular approach? Okay, I have ignored the residual value. Okay, everyone comfortable? So $1,000 times 40%, that's my calculation then over there. $400 depreciation. This method says take the $1,000, the cost price, work out your depreciation charge, $400. What's its carrying value? Remember, guys, whenever you see the word carrying value gives us the value of the asset as it sits then on the balance sheet. $600, which is I got by saying $1,000 cost less $400 depreciation, $600. When I come in year 2 to calculate my depreciation charge, I base it on the 40% and 40% times, but I base it on the carrying value of $600, giving me an amount then of $240. Okay, then I say to myself, okay, what's its value at the end of the year? And we go on based on that, and we keep doing that time and time again, and I get my values based upon that. Okay, so and that's why, as you can see, just some important points to notice from this particular method. The early years, higher depreciation gets smaller and smaller and smaller, but I always base my depreciation on the carrying value, not on the cost price then of the asset. Okay. Good. Everybody comfortable? Okay, and we keep doing it that way. Okay. we see over here, top of page 5, if we were to double the useful life of the asset to 10 years, well, you can just change the depreciation charge, okay, and obviously we know, okay, the useful life of the asset then would be 10 years. Okay, 10 years would be 10% per annum. Is everybody comfortable? In the previous example that I did, we made it over 5 years, and 5 years was equal to 20% per annum. But remember, what's this method called? It's called the double declining method. So remember, in the previous example, I went 20%, times 2, and that's why, if you remember that example, I depreciated by 40%. If I now change the useful life of the asset to 10 years, that under normal circumstances would be 10% per annum. Double declining method, double means I do it by 2 times, so I depreciate here by 20%. Can you see over here why in this example, when I change some of the detail, I now go $1,000 times 20%, not 10%. It's the double declining method, okay, so it's times by 2. But the methodology remains exactly the same then after that. Okay, and what are some of the impacts of using different depreciation methods? Okay, high depreciation, okay, if I use this accelerated depreciation method, higher depreciation expense. And always when you think about this, guys, think to yourself, okay, well, what depreciation method am I using? So first and foremost, okay, I'm using what we call the double declining method, okay. That's increased depreciation in the early years, lower depreciation in the later years. But now remember, if there's more depreciation in the earlier years, what does that mean for income? Lower net income in the earlier years, high in the later years, because remember, the higher your expenses are, the lower your net income is. Okay. And this is how you need to start to think when you start to do financial statement analysis, this particular section, is you've got to think about what are the impacts of what your accounting choice is going to have on everything. Lower shareholders' equity in the earlier years. Your return ratios are lower in the earlier years. Why are your return ratios lower? Your return ratios are lower because, okay, your net income is lower. Why is your net income lower? Because your depreciation is higher. Okay, your turnover ratios, okay, things like fixed assets turnover are higher because you've got lower asset values. Okay, so just a little, it's not difficult to conceptualize these, but it is important that when you do these kind of things, you look at the impacts that it has across the board, going down on income statement, balance sheets, and then cash flow. Okay. What happens if a company decides to use a different depreciable life? Okay, it shortens the life of the asset. In other words, okay, the life of the asset, and just very important this. Let's say, for example, the life of the asset was 10 years. If it was 10 years, I would depreciate by 10% per annum. Now I'm going to shorten the life. I'm going to make it 5 years. What happens now? Now I'm going to depreciate it by 20% per annum. What are you doing? Are you being more aggressive in your accounting, or are you being more conservative? And what's interesting is you're being more conservative, because when you shorten the depreciable life from 10 years to 5 years, what are you doing? You are increasing the amount of depreciation. What are you doing to your net income, guys? You are reducing your net income. And just something very important to note, we'll see it later on again, anytime that you reduce your net income, okay, you're being conservative. Why? Because you're saying, well, let me rather take less net income now, okay, just to be more conservative. What would aggressive be? Aggressive would be if I take my depreciation now over 20 years and I'm only providing for 5 years per annum. What would happen to my net income? Well, that would go up. Then I'm being what we would call, that's aggressive. That would be adopting an aggressive accounting policy. This is a conservative accounting policy. Okay, and you can just see all the impacts of that. If I reduce the life of the asset from 10 to 5 years, I increase the depreciation charge, I reduce my net income, okay, and there we go, those are all the impacts for you there. Okay, top of page 6, what if I use a different salvage value or different residual value? Okay, and let's say, for example, initially, what did I do? Let's give you an example. Here was my initial calculation. Remember, I had $1,000 as my cost price, and I made my residual value stroke salvage value 200. There is my $800, and let's just say, for example, I'm depreciating 20% per year over 5 years. Be 20%. What's my depreciation charge? 160. What if now I decide to go 1,000, and look what I'm doing? I'm using a decreased salvage value. I'm only going to be using $100 salvage value. So now the depreciable amount of my asset is 900. Keep the rate the same, I'm not changing that. And what happens to my depreciation charge? It goes up. So if you decrease salvage value, you're being conservative, you've got an increased depreciation charge, and then if your depreciation charge is increased, your net income then is lower. Okay. What do you notice? We've spoken about as you move things around and you change your estimates and you do all these kind of things, depreciation changes, net income changes, my asset values move around, asset turnover moves around, etc., etc. But what does not change at all, guys? Nothing changes then on the cash flow statement. Why does nothing change on the cash flow statement? Because remember what? Depreciation is what? It's a non-cash item. It doesn't have an impact on the cash flow, but by me changing the amount of depreciation that I charge doesn't give me any more or less cash in my business. Okay, just an important one then, guys, for you to remember. Okay, we look over here, guys. Now we carry on with non-current assets, but we're looking at intangible assets. What's an intangible asset? For example, like IP, okay, intellectual property. For example, anything like that would be called an intangible asset. You can't feel and touch it, but it still does have value. Okay, and let's have a look over here. The same methods that we use for tangible assets can also be used for intangible assets, of course, provided that the intangible assets have a useful life. And I say, well, hold on a second, I believe that this intangible asset that I have has got a certain life to it. Okay, they amortize over their useful lives. Every year we've got to test them for impairment. What does it mean we test them for impairment? We test them for impairment to the extent that we say, hold on a second, okay, maybe the value is not as we initially thought that it was. Maybe we bought this particular intangible asset and it was a bit of a bad investment. It's not really worth what it's worth for whatever reason. So we test it annually to see if it's still got its value. That's called an impairment test. Okay, and just like we saw, okay, for tangible assets, the different methods, straight line production and declining, as well as double declining methods, we can use those also then for intangible assets. But before I can start to amortize an intangible asset, I need the starting value of the intangible, how long I believe it will be its useful life, and again, is there any kind of residual or salvage value? Okay. If an intangible, and I say how long, what's the useful life of this particular intangible, this intellectual property, or any other kind of things like goodwill or things like that, and the answer that I get back from my team is that it's infinite, it's infinite. In other words, the life of that asset is forever. Okay, then no, we won't amortize it, because how would you amortize something if it's going to be around forever? And I cannot amortize it. Okay, but still I've got to test it for impairment. In other words, I've got to test this asset on an annual basis and say to myself, is this asset still worth what it was worth when I initially bought it? Yes, good. No, then I would need to impair it and write it down to its value. Okay, an asset that is impaired, that amount that I impair and I write it down goes straight through my income statement and is recognized as a loss. Let's have a look over here. It's an example, some value of intangibles. Okay, and here's some nice examples of intangibles: copyrights, patents, goodwill, licenses, franchise agreements. Okay, I'm not going to look at all of them with you, but let's just have a look at some of them. My copyright, it's worth $100,000. Okay, the copyright will be sold at the end of 10 years. That is its useful life. And what's its value at that date? $20,000. Let's see what I do. So I take my $100,000 which is its initial value at the beginning of the year. I subtract 20,000, that is its residual value. In other words, I'm depreciating it based upon $80,000. What's its useful life? 10 years. So I go $80,000 divided by 10, and I depreciate it by $8,000 every year. Let's have a look at the next one. Okay, a patent, 500,000. It'll expire in 5 years' time. Nice and easy. 500,000. It's got no residual value. 5-year life. 500,000 divided by 5, and I depreciate it by 100,000. Okay, every year. Okay. Goodwill. Let's have a look at it. We'll just do one more with you. Okay. Goodwill is $250,000. Okay, the goodwill arose from the acquisition of a business combination. 250,000. How long will it last for? Well, as long as I've got the business. Okay, so no useful life. I don't amortize it. The useful life is essentially forever. Okay, so that 250,000 does not then get depreciated or amortized. Okay, there we go. Some nice examples for you. Remember what we said a little bit earlier, that if the value of your non-current asset goes up, okay, well, we can then use the increased value. That's called the revaluation model. That's as opposed to the cost model. The revaluation model allows us to keep things at their new values. Okay, per US GAAP, no, we can't. US GAAP only allows what, guys? Historical cost, less accumulated depreciation, less any kind of impairments. Okay, so US GAAP, we don't allow for any kind of revaluation or what we call fair value accounting. IFRS does allow long-lived assets to be recorded at their fair value, and we call that the revaluation model. In order to be able to revalue to the value that you would like to revalue to, you need an active market for the asset. The fair value of the asset then can be reliably estimated. The same treatment must be applied for all assets within that group. You can't half the assets in the asset group, half of the properties, well, we'll keep them at cost, and the other half we'll decide, are we going to revalue those? That, of course, you can't do. You've got to be consistent across the board. When a revaluation is applied, all the assets within that class must be revalued. Okay. And when you're applying this model, assets can be written up above their original cost or to wherever their value is. Okay. What about a downwards revaluation? Okay. What if the value of the asset now has gone back down, has declined? Yes, it will need to be written down again through the income statement as an expense. Okay. If it goes up again, well, we can write it back up again. Okay. But obviously, okay, it'll have to be a proper increase in value. Okay. So just an important note. Okay. The amount that we write up can only be written back up through the income statement as a gain to the amount that it was written off before. You can't write it up. You can't take it through the income statement more than it was written up to before. Okay. If the value of the assets increased and the asset needs to be written up above what you even paid for, let's say, for example, you paid $1,000 for it. Okay, you paid $1,000. That was its original cost. Okay, $1,000, and now the value, the property that you bought, is now worth $2,000. So we need to increase its value per the revaluation method, per IFRS only. Okay, that cannot go through the income statement. You can't say, well, oh, look at that, there's a nice gain of $1,000. Let me take that through to the income statement. We take it straight through to the balance sheet, and it's called a revaluation surplus, and it results in an increase in equity. If the value then goes down, well, just like we wrote it up through the balance sheet through the revaluation surplus, we will do the same thing on the way down. Okay. Top of page 9. Okay. When assessing the effect on financial statements and the ratios, we need to take into account the various accounts that we consider. Okay, and we spoke about that a little bit earlier. You need to say, well, what accounts get impacted? Does the income statement get impacted? Well, it depends if you're writing it down through the income statement. What happens to the balance sheet? okay, and you work through those, okay, but remember each case will be different depending on what specific item has been impacted then as a result of your changes that you've made, etc., etc. Okay, what about the financial reporting for investment properties, okay, as opposed to normal assets? In other words, you bought a property for the purposes of investments. What would IFRS tell you? IFRS will define a property, okay, that a company owns, and why do they own it? To generate rental income, or they want it for capital appreciation. That's called an investment property. IFRS again would tell you, how do you account for this? Cost or fair value, and we've spoken about that before, okay, but it would need certain disclosures. Okay, what are some of the disclosures? All the usual disclosures that we have for long-lived assets. If I decide to go for the valuation method as opposed to the cost method, we also need to disclose the date that we did the revaluation, the determination of the fair value, details of the revaluation, and historical cost carrying value. Top of page 10, transfers to and from investment property. Okay, if a firm transfers its current property that it's owned into an investment property, or other way around, if it is owner occupied and now it's being transferred to an investment property, we use cost, no change in treatment. What about if we're transferring from inventory into an investment property? Same story, cost is what we recorded at and no change. What if it was an investment property and now we're going to use it as for owner occupied property? Cost, no change. Okay, what if it were owner occupied? Okay, and another way we can do it, investment property. Remember, this is IFRS. We can also use fair value if we so choose, and if we did so, we'll treat it like a revaluation. So you can see over here, I'm going to just get rid of those so we can just keep the colors consistent, guys, and we can see it nicely. Okay, that from owner occupied to investment property, okay, under IFRS you can either keep it at cost or fair value. Okay, from inventory to investment property, again, same story. You can go for cost or fair value. Okay, just remember, if you're taking it out of inventory, remember you kept your property as inventory. Now you're recording it as an investment property. If there is any difference in the carrying value, that must be recognized as a gain or a loss. Of course, if you're going from inventory to investment property and you choose the cost approach, well, then there's no impact there then at all. Okay, and lastly, if you choose to go investment property to owner occupied and you choose the cost method, no change. But if you go investment property to owner occupied and you decide to use the fair value or the revaluation approach, okay, then yes, the fair value now becomes my new cost. That brings us to a close then of learning module 6, long-lived assets over there. Okay, on page 11 we've given you a little bit of a summary over there, okay, over the page, and onto then page number 12. Taking us back to the beginning of this particular learning module, as you can see, guys, it wasn't an overly crazy difficult one. We dealt with depreciation rates and all that kind of good stuff, and we looked at the different kinds of assets and how we depreciate those, ranging from property, plant and equipment. Then we looked at things like goodwill and things like that, okay, what we call intangible assets. And then we had a final look then at investment property as another type of asset, moving those in between the various different types of accounts. This then brings us to a conclusion of learning module number 6, long-lived assets.